Okay, hello and welcome to the Business and Personal Finance unit of Foundations of Business, specifically managing a payroll and inventory. Let's talk specifically in this section about inventory. Now, in the last section, we talked about payroll as being one of the most significant expenses a business has to take on. Well, inventory is one that probably isn't that far behind. And managing inventory is almost an art form of a process by accountants in order to be able to manage expenses. So let's go ahead and get started. Make sure that you have your note guide that accompanies this section's presentation lecture so that you can complete the notes and submit for credit once you have completed viewing the presentation lecture. All right, so in this section, we're going to talk about inventory. So this is the amount of merchandise that is on hand at any particular time. That is going to be sold to customers or transported to retailers. Take a look at a store like Walmart for a second. If you think about Walmart, how much inventory is in that store in order for customers to be able to walk through and purchase? Millions upon millions of dollars of inventory on display for customers to purchase on a daily basis. So as you can see, inventory can be a significant expense when it comes to a business operation. We will talk specifically about establishing an inventory system, the importance of being able to control inventory, determining how much inventory is on hand, determining the cost of inventory, analyzing inventory turnover, and then finally how payroll, inventory, and cash flow are all interconnected. All right, hopefully by the end of this presentation lecture, you will understand how to describe the methods of determining inventory quantity, how to calculate inventory using various costing methods, and how to analyze inventory over turnover. This is important because maintaining adequate quantities of merchandise in inventory enables a business to meet the needs of its customers while being able to manage cash flow. If the customer does not have a product to buy, the customer will get unhappy, and the customer will probably try and buy it from a competitor. So it's very important to have the needs and wants of customers on hand at the time that they need it and want to buy it in order to be as productive, profitable as possible. All right, so let's take a look at establishing an inventory system. Now, to control the purchase and sale of merchandise for a business, we must establish an inventory control system. This is going to consist of tracking the quantity and the cost of merchandise purchased, as well as the merchandise that we have in stock and the merchandise that is sold to customers. So this is a circular system that we are going to see as inventory comes in, is stored, and then goes out. Tracking and controlling inventory is also a major function of the accounting system. The managing of inventory, very, very important process. All right, let's take a look at the stages of merchandise. So merchandise moves from the time that it is ordered until the time it is sold. The stages of the merchandise are ordering, which means that we order the merchandise in order to make our product to sell to customers. Then there's also the storing, which goes into our warehouses, which is a safe, efficient manner. Displaying, which is the ability to get it to retailers so that it can be on display and be attractive to customers to try and influence buying behavior. And then finally selling, which is the actual purchase of the product by the customer, which brings cash into our business as well as reduces our inventory cost. All right, so the importance of controlling inventory. If inventory is too large, the wrong kind of quantity of items have been ordered, we cannot move them. That is a sitting expense that we have purchased and paid for, but are having difficulty trying to sell. If inventory is too small, that means customers won't have efficient choices and they will find other ways to meet their needs and wants, possibly, most likely, purchasing from our competitors. Now, maintaining an appropriate level of inventory is crucial in order for good business management. And it is not always the easiest thing in the world to manage. First, we have to determine how much inventory that we have on hand. Two accounting methods are used to determine the inventory that is on hand. One is the perpetual inventory system. This keeps a constant, up-to-date record of merchandise on hand. This is going to give us an accurate picture of the amount of inventory on hand in most cases when that information is desired. There's also the periodic inventory system, which updates inventory records only after someone makes an actual physical count of the merchandise on hand. So, two different methods which can be used in order to determine how much inventory that we have on hand. Now, once we have done that, then we have to determine our cost of inventory. So the cost of inventory is going to be assigned value based off the cost of each item, and each item may not be the same. Therefore, the cost of that item, the cost of inventory, has to be calculated on an individual item-by-item basis. So there are three standard methods which are used. There's specific identification, there's the first in, first out, or FIFO method, and then there's the last in, first out, or the LIFO method. We're going to take a look to see how the cost of inventory is calculated using each of these methods. Now, when we analyze our turnover, this is also going to factor into our cost of inventory because inventory turnover represents the number of times that we are able to sell our inventory in a given time period. How fast is certain inventory items moving out of the warehouse and into the hands of customers? That is what we want to be able to find out so that we can keep our inventory adequately stocked as well as meet the needs of the customer. So to calculate it, we need to divide the cost of the merchandise that is sold in a given time period by the average amount of inventory. So a high inventory turnover rate means that our business has money tied up in inventory for shorter periods of time. Inventory that we have stocked that we are having trouble moving or selling. All right, so let's take a look at how to calculate out average inventory. So we have the value of the beginning inventory plus the value of the ending inventory, and we divide that by 2 to get the average. So if the value at the beginning of the accounting period is $65,000 and at the end it is $80,000, add those two together, divide by 2. The average inventory that we have on hand for this period is $72,500 worth of inventory. So now if we want to determine the accounting or the inventory turnover, we're going to take the cost of merchandise sold and divide that by the average inventory. So let's say, for example, that Cindy's Fine China sold $200,000 worth of merchandise. We take that $200,000 cost of merchandise sold, divide it by the average inventory, which we calculated on the previous slide, $72,500, which means our inventory turnover rate is 2.76. Now the inventory turnover rate for Cindy's Fine China, 2.76 times per year, is the amount of times that it's going to turn over throughout the course of the accounting period, which in this case is 1 year. So then we also have the number of days in stock, which is also very important. So the inventory turnover for Cindy's Fine China was 2.76 in 2002 and 3.25 in 2001. So how many days did the merchandise remain in stock each year? So there's 365 days in a year. We divide that by the turnover rate. That gives us the number of days that it is in stock. So if we have a turnover rate of 2.76, we take 365 divided by 2.76, which is going to give us about 132 days, which is going to then be divided by 3.25 for the previous year, 112 days. So merchandise remained in stock for about 132 days in 2002 before it was sold, and 112 days in 2001 before it was sold. Now, how is this going to impact cash flow? Well, cash flows through a business is giving it the financial resources it needs to operate profitably. So cash flow is crucial in this whole process in indicating how payroll and inventory are impacting our overall financial health. Payroll and inventory are two financial areas that have great influence on cash flow as well as the life of a business. Let's see how they impact it. A successful business carefully is going to monitor the cash and constantly analyze payroll and inventory costs and look for ways to be able to make cuts if necessary in order to become more profitable. All right, so this concludes the presentation lecture on managing inventory. Please make sure that you go back and revisit the slides as necessary in order to complete your note guide. Once it is completed, please make sure that you submit it in Google Classroom for credit, and I will see you next time we meet in class.